everyone. Welcome to the trading room for the week of May 16th through the 20th. I'm joined with, this is Darren Fisher. I'm joined with Corey Halliday. Let's go ahead and get started. As always, trading contains risk. Make sure you're sizing yourself correctly and following your trading plan and not getting too far out over your skis. So last week's events, it was a pretty interesting market. The markets were down the first 3 days. And then on Thursday, we hit a bottom. And Thursday was really interesting. You had a lot of big, a lot of action going on intraday on Thursday. I had actually exited out of some short positions and got into a long position, and then subsequently got stopped out of that long position. But then Friday it had gapped up. So definitely an interesting day. We've had 6 down weeks, and there was that big reversal. We put the bottom in on Thursday. We confirmed it on Friday. It was really down. I mean, we would have been down, 6.4%. We rebounded, 4% on Friday. I mean, these are huge swings. Okay, so one of the reasons that we took a look at this is because the markets were so far away from their moving averages. If you looked at a chart, I think it was the NASDAQ, and you could see that, and this is the index itself, not just the 100, you could see that the price action was 10% away from where the 20-period moving average is, which is huge for an index. So we were bound. We're looking at this right now as the first stages of reversion to the mean. So much energy has been expended to the downside. It's gotten away. People are coming in. They're liquidating short positions. That's going to cause buying right there. Some people are taking a fresh look and instituting new bullish positions. So we really see this as short term. Probably one of the final dominoes that fell was when Apple broke down. It had been holding in there and holding in there and holding in there, and then finally on Wednesday and Thursday, it just broke down. If you take a look at it, and that was one of the things that had been holding up. That was probably the sign right there when you saw Apple break down that we were at a tradable bottom right here. I'm not going to say I'm not going to say a near-term bottom. I'm not going to say the bottom of a bear market. We're in what we think is a tradable bottom. Inflation may have reached its peak, but it's still staying high. The consumer price index month over month came in at 0.3% versus a 0.2. Oil and energy, though, continue to remain strong. Many other commodity assets are falling, though, as well. And in some cases, I think you're seeing the beginning of demand destruction. And that's when the prices in some things get so high that people no longer buy them, destroys the demand. That naturally brings the price down. Well, that's not true for oil and energy right there. It's still very, very strong. Economic reports, the core CPI month over month came in at 0.6 versus 0.4%, so hotter than what the economists expected. And the producer price index came in line at up 0.5%. So let's take a look at some market analysis. Corey, why don't you walk us through this?
Yeah, thanks, Darren. So as we look at the markets, I mean, I like how you kind of talked about a tradable bottom, and that's really kind of where you're at. So as you look at the returns for this week, gold has had a rough few weeks. In the commodity space, it's oil kind of stands alone. Copper's down big. If you look at some of those commodity charts, it's pretty ugly like so many other things. We all know how crypto has done. There's not many things that have kind of been able to weather that storm, so to speak, and oil has done that, and energy stocks have done that, by the way. So for the weekly return, still an ugly week in that all the indexes finished down 2, but considering that just on Thursday we were down 6% for the week at one point, that's a pretty good bounce so far. And speaking to your point, if we kind of take a closer look at these charts, you can see that stretched price action that you were talking about. So how far away, at this point versus where the S&P was, 10% or more, that's the 20-day moving average. So if you just kind of think about mean reversion, as you get stretched away on the upside, there's often kind of that pull back and that pull back to these moving averages. As you get stretched to the downside, it can kind of get a little bit more extreme because prices don't usually crash up. They kind of crash down, right? There's more panicky behavior on the downside. So, but you can see as we stretch, we kind of think of it like a rubber band. You're kind of stretched out and then you kind of revert to the mean, and then you stretch out again and you revert. So we get stretched to the downside and we revert back to the mean. And now we stretch to the downside and we revert back to the mean. Well, we were definitely very, very stretched. I mean, this price action in the S&P, the distance between the 20-day and where we were hitting on Thursday is pretty much like what we saw back here when this breakdown began. If you just look at distance and percentage away and so forth, and at that level, what has to happen for prices to stay down? For somebody that's short, just think about you on the short side, you as a bearish trader. Are you tempted with markets having fallen for 7 or 8 days in a row and prices that stretch and so on? Are you tempted to take some profits on your short and are other people and because you're all tempted to take some profits on those shorts, you do that. And that's buy to cover, right? We're buying to cover our short positions. We're buying back the short positions that we have in those assets, and the expectation is that that will kind of cause us to bounce temporarily. So I don't know, like Darren said, I mean, I'm not ready to call this the bottom, but you definitely have the tradable bottom. And here's the tricky part of it is I'm not sure that it just goes screaming to the upside. So as you kind of look at the price action in the Qs, the NASDAQ, same thing where, again, we're kind of stretched and it will be a convergence of sorts. This 20 period moving average coming down, the price action coming up. And, I think that they kind of converge, that reversion to the mean, and there's a little bit of a consolidation, probably further bounce. I doubt that, Friday was the high, but it'll be choppy in nature. It won't just be you know, we hit our low and we just go screaming to the upside in all likelihood. Instead, you'll rally, and some people will say, boy, it sure didn't feel good on the declines. I want to take some money off the table. And so that kind of keeps a lid on the upside. And, you kind of revert back to the mean and you come back to those moving averages and then you kind of flatten out for a period of time. As we look at the VIX, it kind of speaks to the fear and the nervousness with the VIX spiking back up here in the mid 30s. You can really look at this as kind of could be setting up. I mean, if the next shoe was to drop, I suppose from a charting standpoint, you're setting higher lows, but you've kind of flattened out on the top side. You could go up and through if there was the quote unquote next shoe to drop. If you envision a scenario where the markets are going to get just cascading lower, a la 2020 with COVID or 2008 in the global financial crisis, in order to get up there where you have VIX at 50 and 60 and 70, you need something really, really bad to happen. Well, I'm not going to say that that's a high probability scenario, but it's more possible today than it has been for the prior for all of 2021 and so forth. Meaning, we've seen some negativity. We know that the Fed is in this tightening dynamic. There's a dislocation in prices, and there's a lot of nervousness out there, and that's kind of again, it's not high probability, but those are the scenarios that could see crashes and could see some really wacky things. So you just have to be careful out there. Don't get caught thinking that markets can't do something. Oh, it could never get to there. No, anything's possible in this market. You're seeing stocks that were down, 50% on their earnings, quite a few and big name companies. Even the biggest market caps in the world, the Amazons, they were down 20% on their earnings. Netflix, which is a huge multi-billion-dollar corporation, down 30 and 40% on like one-day events. There is a ton of volatility and potential for risk in this market, so it needs to be respected. As we look out to next week, markets have kind of bottomed out very short term. We expect a bounce and we expect a little bit of a convergence between price and moving averages. Price should go up, but be kind of choppily so, but should still continue to climb a bit as those moving averages come down to meet it. Fed Chair Powell speaks on Tuesday. A lot of people are upset, kind of feel like the Fed has lost credibility. He recognizes that and even made some mention of kind of their mistakes. He said, in hindsight, we should have been raising rates sooner. We're behind. We're slow to move. He kind of referenced the fact that, hey, we haven't probably done things in terms of policy the right way. And it's shocking to me that it just feels like most all of us could see that coming, right? We could see it coming, and that there was just so much money being printed and so many things that, as an academic, you would think that they would just understand the whole, hey, we flooded the market with more cash than ever before. It's kind of the helicopter Fed where we're just dropping money from the sky, sending out checks and doing this and that. Well, that spurs inflation. The fact that they were kind of caught off guard by inflation is just mind boggling to me, because how in the world, what if they studied their entire lives that if you have those types of policies, the risk you run is really hot inflation. Now they're dealing with the consequences of that, but it's almost like they couldn't see it coming. Are you kidding me? So retail sales come out on Tuesday, month over month, not expected to have any major surprises. And in terms of the consumer, the consumer's still spending. I don't expect some major surprise in retail sales, but you never know. It's more about housing and housing affordability and higher rates and so on. So I think retail is still doing fine, but you might see some really bad housing numbers, new home sales, things like that coming through the pipes that could really disrupt the market. So those are some things that are coming out this week. Darren, back to you.
Yeah, thanks, Corey. Yeah, so our outlook for this week, and you're going to see this as we go through the sectors as well. We're saying that Thursday was a bottom, Friday was confirmation, and this next week is going to be a +2. I think we're going to have some heavy action to the upside, and then we'll see, as you mentioned, when the 20 period converges with the price action, what's going to happen there. I mean, this could go all the way up to the 50 period moving average and still be very bearish. I mean, so if you take a look, you remember what we did in March. We had an 11% move in just a couple of weeks. I mean, that could come there. And if you took a look at our videos, trading a bear market, the characteristics of a bear market, you can have some moves that are just rip your face off to the upside. And if you're short, that hurts. So what we're going to be telling people, and you're going to see in the trades, we're going very, very tight time horizons on these next trades if you're going to be to the bullish side. Monthly outlook, still a -3. So let's take a look at some sectors here. So you can see not a green sector in the entire bunch. Everything was down. Real estate was down the biggest. Consumer was also down as well. Tech down, over 3%. So you've got 3 sectors right there that were down over 3%. Another 3 that were down over 2. And, if you can call, -1s at utilities, communication services, and healthcare as the, as hanging in there, that's the kind of market action we got. And that's even with the bottom on Thursday and the bounce on Friday. So let's take a look at the individual sectors here. Utilities here didn't hold up. I mean, it held up pretty good. And, I had a 0 on utilities for the last 2 weeks. I've got a 0 on utilities that go this week moving forward. I think we base right here. It seems to have found a really good support level at about that 71 area, 70, 71 area. And the bears out in the chart. So I definitely, I think this is going to base for a while. Possibility that it goes up and starts moving again from there. Moving on to communication services. I'm at a +1 on communication services. And remember, this is strictly in anticipation of a bounce. Comm services went way down. It was at a -3 last week, and it was very, very weak up until Friday. So everything that's going to be predicated on a bounce, I think this goes up, to a +1. I don't think we get a whole lot of movement in a lot of these beaten down sectors, but I think that movement is to the upside. Same situation with real estate here. We're going to see real estate. It came down hard. You can see it was the worst performing sector out there. It did have a very good day Thursday, a good day on Friday. But I think that there's still a lot of technical damage done. I give this +1. You could make me the case that it's come down so far so fast that it merits a +2 to the upside. And I completely agree with you. The key point here, any movement to the upside is going to be fairly short term, we feel. On to industrials. Here's another one. A little weaker on Friday. We did have it was more of a fight. You take a look at that candle. It didn't close at its highs. So again, I'm +1 on industrials right here. I think it floats up, and then we're going to have the convergence of the 20 period and the price action. And it's the same for a lot of these charts. I mean, you take a look. We didn't. You're going to see this later. I don't think we got capitulation on Thursday, because you take a look at the volumes on Thursday, and they didn't overwhelm the volumes on the previous 5-6 trading days. And then on Friday, you had even less volume, even though it was a confirmation. I think this runs out of gas fairly quick. That's where I'm coming from here. Moving on to healthcare. This is another one, same situation. I'm at a +1 on healthcare. Again, you take a look at the volumes on Thursday and Friday, less than the previous several days. There's just still a lot. There's not a lot of conviction in here. Now, the good thing is it did kind of hold in at those January lows. I mean, it's in the same band as those. So this might be more of a longer term bottom for healthcare here, quite possibly. But again, it's the same for a lot of these sectors. Moving on to financials. I'm actually at a 0 on financials. Reason being is you take a look at Friday's candle, and that's pretty anemic. Is the range that we went up through the day for financials to only eke out that little bitty, that little bitty game, most of it being on a gap up. There's just not a lot of faith in financials right here. So I think this more bases maybe floats to the upside a little bit, but I'm at a 0 on financials. Not looking for a lot of stuff there. On to consumer, same thing as, I've got 5 sectors at +1 right here. Consumer being one of them right there. Same thing. We're beating a dead horse. Talking about the reasons why. I think we float up a little bit. This one could have a little bit more meat to it, but I think it does just float up for the next week or so. Although taking a look at tech, this one's a little bit different. Tech had a little bit better day on Friday, and it was up 3 1/3% just on Friday right there. So I think this one has a little more velocity to the upside. So I'm at a +2 on tech. That's completely the velocity play. As a lot, if I was looking midterm or longer term, I'm just going to use this as an entry to get in there and go short. I think we definitely could have some resistance at that 140 level, and you give it a couple of days to get up there. That's about the time the 20 period moving average is going to get down to that level as well. So that's where I'm looking for a possible turnover right here. Materials. I'm at a 0 on materials. I look at that long upper shadow and seeing, okay, we did make a gain. It was decent, but there was a lot of selling pressure came in. I think we're taking a look at the volume as well. I think we more base here and let the moving averages come to us, and then look for a possibility to break through the moving averages to the upside, or turn over once the moving averages catch up and break below that 80 area. That's what I'm looking at for materials here. Energy is the gift that keeps on giving. And this thing pulled back, hard on Tuesday there, it looks like. Hit the 50 period moving average. A little bit of chop on Wednesday. Thursday, you think it looks like a shooting star followed by a hammer on Thursday. Wednesday was shooting star followed by a hammer on Thursday. And we have a really good candle. this just basically pulled back to the 50, and we're up from there. This could be confirmation candle of a bull pullback. Got to go +2 on energy here. So let's rack and stack everything and see how everything looks right now. You can see everything is shifted to the right, but the highest rated ones, technology and energy, at a +2. Energy is the only one that I think is a true +2. Technology is just a bounce. We've got, again, 5 sectors at +1. Consumer, healthcare, industrials, real estate, and communication services, and that's predicated, as I said, on the rest of the market going up as well. Stuff that I think is just going to hang in there and base for a little bit: materials, financials, and utilities. So let's take a look at some possible trades here. So we're looking at utilities again. Utilities has been pretty good. Last week we had Duke Energy long. That was down 1.97%. And if you're still in that Duke Energy trade, that's okay. I would just watch it and see where it go. What we're looking at here right now is Energy. Ticker's NRG, and you can see we had a monster day about a week ago, and then despite the market action, we still went up in this nice little flag pattern right there to the upside. It's just we're melting up in what was a down market. So I'm looking at this one. I'm going to be going out to June. Go long the 40s and short this Friday's. Remember, this is expiration Friday this week for monthly expiration. Short those 42.50s and then reevaluate the trade from there. So this is one of the better looking ones in utilities, even though utilities was a down sector. Taking a look at communication services. So last week in communication services, we were short AMC. And we're glad that we were short AMC because AMC was down 14.14% for the week. So if you're in that trade, pat yourself on the back. Probably a good time to take profits. And anytime you've got that big of a profit in it, sometimes it's best to just bring the register and move on and be happy about it. This week, we're looking at Lumen Technologies. You could just say, this is a nice bull pullback. We're at resistance. A little bit of chop this week, but we're to the upside. Right now, this has definitely got some interest in it. We'll see if we can break through that previous resistance. And but if we get a nice trigger, then I'm just going to do a really wimpy May, this Friday's 5-day trade, 11-12 bull call. As you can see, I'm not expecting a lot out of my trades, and I'm also taking them on a very short time horizon. So for healthcare, last week we had Bristol Myers long. That was down 1.01%, no problem. Merck, though, is what we're looking at this week. This is a nice high base, had a breakout on Thursday. Had a little bit, I'd say it held in there on Friday as well. There was just money going other places. This one's got some legs, though. This one's had some legs since February. So, two different things you can do. Go out to the June long the 90, short this Friday's 95 diagonal spread. Or if you think that this base is a little bit, I don't do this very often. But it's a good technique. The June May 90 horizontal spread. So as long as it just hangs out around 90, you're going to be looking pretty good. Corey, why don't you take us through a few of these?
Yeah, so the industrial sector next, and industrials have held up, relatively well by comparison to some other sectors. Here you can see Expeditors International, uh, relative strength to the other markets. There's not a lot of stocks that are up over the past couple of months, but this happens to be one of them. You can see even a bullish cross in the moving averages. So you can play this. I think Friday's candle wasn't great in that it tried to kind of break out and failed against 115, but I don't think that there's a ton of downside risk either. I think it just kind of speaks to it's going to be a little bit choppy with an upside bias. So something like a diagonal or bull call spread where you're not targeting a ton to the upside, but you're just kind of saying, okay, I think we can continue to hold in relatively well makes a ton of sense. So kind of conservative bulls. We're not trading for huge upside in this market. Financials, as we look at here, First Bancorp. So again, kind of like the other, you can see the relative strength, bullish crossover. We've been climbing to the upside. You can kind of draw a channel of sorts. And we were just looking at this butterfly trade, kind of targeting a little bit more upside movement. I wouldn't even, completely disagree with if you wanted to go out more towards June, you'd move that entire butterfly spread up. Like you could put on one that's more targeting 15 out to June. But if you're going shorter term, like most of these bulls, you just, target stability, consolidations with a little bit of upside bias in the coming days. That would be my market outlook and kind of stock outlook in a nutshell. Consumer stocks. So,
Oh, 1 second there,
yeah.
Corey. I want to talk about our consumer trade last week. Yeah, last week in consumer, we had American Eagle Outfitters, AEO. We were short that. It was down 0.8%, one of the ones that kind of held in there. I think it had some pretty good market action on Thursday and Friday. So we're going to look to see what that one does. Not a lot of movement there. This week in consumer, we've got international paper. This is another sideways trade. This is one of the ones that we're taking a look at. We're not going to be overly bullish. We're just thinking hold in there, like you said, Corey. I'm liking the May 45, 47.50, 50 call. 5-day trade that it hangs out around 47.50. You can see that's where it closed, right out there on Friday. So I just don't think we get a whole lot of movement either way on this one. I'm happy to just play 5 days of time decay and think that this thing doesn't move anywhere. So in technology last week, we had a short in digital turbines, APPS, and we were happy with the way that one turned out. That was another good one. That was down 6.9% for the week, so we're definitely glad to be in that one. A little mixed bag this week, but that's completely fine. So this week, we're looking at Western Digital, and this has had about a 2-week pullback, to the, after a gap up. I mean, so it basically filled that gap, and we went down to the 20-period moving average. We confirmation on Friday that the bull pullback was over. Looking really good right there. 2 different ways to play it. So you want to be a little more conservative. That this Friday's 57.50, 62.50 bull call spread, a little $5 spread right there. If you think this has got some legs to it, go out for the June 55s, and then I would short this Friday's 60 against it. And last week in materials, we had Alcoa short. And this is another one that turned out pretty good for us. Alcoa was down 4.5%. So we're happy to take that one. There's been a lot of weakness in materials that we're seeing right now. But this one is looking pretty good. The Olin Corporation, OLN. This is another one. Bull pullback right to the 20-period moving average. A lot of market action, a lot of price movement on Thursday and Friday. This one looks to be pretty good. Conservative play is the this Friday's 62.50, 65. I mean, that's about as wimpy as you can get in a stock this price to go to the upside. A little $2.50 spread. A little more aggressive. You think this has some more legs to it. Long the June 60s and short this Friday 65.
Yeah, and Darren, just to kind of chime in on this one, you can kind of see a pattern that I often reference where looks like you kind of came up to that resistance zone after having bottomed out for a big period of time and then initially failed and backed up, and that kind of creates that little cup and handle. So it should be a little bit of a consolidation here, but big picture, you might even get a bigger breakout. Kind of an interesting big picture chart pattern there.
Energy last week, we were long Apache. This one did turn out too well for us. That's okay. Being long Apache, we were down 6.69%, but you can see the energy sector did take a little bit of a hit. This week, though, we're looking at Valero. This is another one. Nice bull pullback. Confirmation of the bull pullback was over on Friday. Conservative play, again, just a 5-day 125, 130 bull call. If this one though, you can see it's had legs since January. It's been looking really good since January. Been in a nice uptrend. Starting to go parabolic here. That's fine. Play it till it's no longer good. Long those June 120s. Short this Friday's 130. There's a possible play right there. So conclusion, we're gonna go out there and say short-term bottom is in, but we didn't see traditional capitulation. We didn't see massive volume. We saw a nice reversal on Thursday, but it didn't have the volume. So that's why we're saying this is just going to be a tradable bottom, and it's probably going to be pretty short term. Since we think it's going to be pretty short term, we want to keep those trades, keep the bullish trades short term as well. And as always, look at proper position sizing. Take a look at your capital allocation sheets. Take a look at what the market's saying in midterm and long term, and then you can shorten things up and take it from there. So we're possibly going to get a couple more classes on the schedule. If not, we'll definitely record them and let you know that we are recording them. Look out for the midweek update on Wednesday with Joe. And if you have any trades that you want to put in there as well, please log on to maverickTrading.com in the members area and go to the forum and post those trades. Thanks, Corey, for being here. Everybody else, thanks for joining as well, and good trading.